Thank you, everyone who have joined us on this very important and interesting topic. Before I go into the introductions, I would like to start with an acknowledgement of country. In the spirit of reconciliation, CHU acknowledges the traditional custodians of the land on which we live and work throughout Australia and the continuing connection to the land, sea and community. We pay our respect to their elders, past and present and emerging, and extend that respect to all Aboriginal and Torres Strait Islander peoples. So we have a very esteemed panel here for you today. So we are blessed with the company of two representatives from the ARPC, the first being Dr. Christopher Wallace, who is the Chief Executive for the ARPC. Chris Wallace's bio was so long, in fact, I had to cut it down for the purposes of a webinar. So in short, what I'm about to read just proves he really knows what he's talking about. But Chris Wallace is an insurance executive with experience in general insurance, workers' compensation, health insurance, medical indemnity and reinsurance. He has worked extensively in insurance leadership roles within insurers and as a consultant to the insurance industry. Chris has leadership experience in most aspects of the insurance sector, including small, specialised insurers and large insurers. Chris is also the president of the International Forum for the Terrorism Risk Reinsurance Pools, for which ARPC is a member. Chris also has a Doctor of Philosophy in Economics, specialising in general insurance pricing and strategy. He is a Fellow of the Australian and New Zealand Institute of Insurance and Finance, Certified Insurance Professional, and a graduate of the Australian Institute of Company Directors. Apart from that, he doesn't have much on. Alexander Drake, we're pleased that he's joining us. He is the Head of Public Affairs for the ARPC. Alexander has held that position at ARPC, where he supports the CEO and board in managing relationships with a wide range of stakeholders external to the organisation. He has over 25 years experience across public policy and financial services organisations across both Australia and the UK. So welcome, Alexander.
Thank you very much.
And also representing CHU on the call is none other than Kimberly Johnson, who is the CEO of CHU Underwriting Agencies, one of Australia's leading strata insurance specialists. Kimberly joined the insurance industry in South Australia in 2005 and has a wealth of experience and knowledge of the strata industry and the strata community. Kimberly is a fellow and a board member for ANZIIF and sits on the SCA's National Insurance Task Force. So before I pass to the speakers, just a bit of housekeeping. There's going to be some slide decks from both parties, both the ARPC and CHU. We'll then have an informal Q&A, like conversation between the two parties. And if there's any time remaining, we've also got some questions which have been posed to CHU via feedback when we released our communications that we had joined the pool a couple of weeks ago. So without further ado, thank you again for all joining us. I will pass over to Dr. Chris Wallace to kick us off.
Thank you, Steve, and thank you, Kim. Good morning, everyone. Alexander and I are very excited to be here to talk to you. We really do like talking about the reinsurance pool, so it's just a pleasure to be here. And we're very happy to take questions on any aspect of what we're doing. Looking forward to that discussion. Just very briefly, I just wanted to also acknowledge the traditional custodians of the land that we're meeting on. Alexander and I are actually in the ARPC office in Sydney, which is the land of the Gadigal people of the Eora Nation. And just at ARPC, one thing we're doing in the Indigenous space is we're hoping to be able to merge our data on cyclone risk, insurance risk, with the Australian Bureau of Statistics, who have good data on Indigenous communities, to see how we might be able to use that information to draw out at-risk Indigenous communities and see how we can reduce their disaster exposures. A little bit on us. Now, we have a short slide deck. It's about, I think, 9 slides or so, just to sort of frame how the Cyclone Pool operates. And we won't take too long on it, but I thought it would be a really good way to just give everyone a quick intro to the pool. Thanks, Alexander's going to throw the slides up. Very good. Whilst Alexander's doing that, I'll introduce ARPC. Thank you. So ARPC is a government-owned reinsurer. So, we look and feel like a reinsurance company, but we are owned by the Commonwealth. We sit in the Treasury portfolio. We have a minister who's our shareholder, and that's the Assistant Treasurer, Stephen Jones. But we're a public financial corporation. So what that means sort of in sort of more practical sort of parlance is that we're a statutory authority. We have a separate identity to the Commonwealth, but we're owned by the Commonwealth. So we work with insurers very closely. In the terrorism pool, we actually have over 220 insurance company customers, and we also offset that risk to the global reinsurance market, and we have over 70 reinsurers that we transfer terrorism risk to in the global reinsurance market. And it's really interesting. We sit on the intersection of the insurance industry, the government sector. We talk to all sorts of government agencies, including weather, defence, science, finance, and treasury. And we also talk to the global insurance and reinsurance industry and the industry in Australia. It's a very, very interesting, but also sort of a privileged position. We've been working for 2 years on the Cyclone Pool. So it was announced in May 2021. We've been working flat out since then to get it up and running. So we'll tell you about how that works. Next slide. Thanks, Alexander. So the Cyclone Pool is operational now. It's all in place. In fact, almost all insurers will be on the pool from the 1st of July. From the 1st of July, about 65% of Northern Australia homes will be covered by the pool. And then by the 1st of November, 95% of homes in Northern Australia will be covered by the pool. And that's at the commencement of the cyclone season. So this upcoming cyclone season, everyone's pretty well in for the household part of the portfolio. Small business and strata will be coming in over time. And the government set up a transition period where large insurers have an obligation to join by the 31st of December this year. In fact, all large insurers, and there's 8 of them, or 10 of them actually, 10 of them, will all be on the scheme by the 1st of November. And so really what's left then is small insurers and specialist insurers, which have a further 12 months through to the 31st of December 24. And so some of those small and specialist insurers include those that do small business insurance and strata insurance. So, so you might see some of those insurers take a little bit longer to join. But the pool, as it's designed, covers 3 things. It covers the wind, as we call it, the extreme cyclonic winds that come from a cyclone. It covers the flooding that occurs during the cyclone, and it covers the storm surge. And in the scheme is 3.3 million homes, 220,000 small businesses, 140,000 residential strata, and small commercial strata. There is a $5 million threshold for small business. We didn't design the scheme. I just want to say up front that the scheme design was done by the Treasury in consultation with community and the insurance sector. But the government adopted a $5 million threshold for small business, mainly because 95% of businesses in Northern Australia fall within that threshold. But we are very conscious that there are businesses that are outside of it, and we're happy to take questions on that and support insurers and if they need information around that.
Just one thing I thought I might add to that point, Chris. We were talking about the larger insurers and the smaller insurers. The legislation that set up the Cyclone Pool has a definition for the distinction between the 2 categories, and that is whether an insurer writes $300 million of GWP a year or not. So that makes sense and fits with the niche and specialist insurers that Chris was talking about a little earlier.
And it's my understanding that that 300 million is across like retail clients, isn't it? Like it's not just GWP for the general insurer, it's 300 million in association with related insureds. Is that correct?
It's $300 million of premium income across all eligible products. That includes small home insurance, small business, and strata.
Right. Okay. Thank you.
There's about 10 insurers that fall into that category.
Yeah.
I had one last thing to say on this. So one was that it covers pretty much, well, actually, it's on a few slides away. We'll see that. It covers all of Northern Australia. So it covers Northern New South Wales, all through Queensland, across the Northern Territory, and a big chunk of Western Australia. We'll come to that shortly. Maybe jump ahead to the next slide, please, Alexander. So the Cyclone Pool is aimed at supporting premium affordability. And so it purposefully requires us to cover all cyclone risks in Australia. And that could happen if there was a cyclone in Tasmania or in Hobart, we would be on risk for that exposure. But we are not collecting premium for those areas where there's no risk. But the pool is designed purposely to give maximum premium savings to medium and high risk areas. It leaves the decision on where those areas are to the ARPC board, and we do detailed analysis on that. I'll talk to in a moment. So it is purposely designed to target premium reductions. It also is, we have an obligation to encourage risk mitigation, and we do that through providing discounts in the formula where consumers have undertaken risk mitigation. And it's all about affordability, and we are trying to encourage disaster risk reduction as well. The next slide, Alexander, sort of shows these areas. So the orange areas or reddish areas on this diagram are areas that have both the cyclonic wind and flood risk. And you'll see that covers the northern part of New South Wales, a large part of Queensland, around Northern Territory, and a large part of Western Australia. The yellow parts in the diagram, there's flooding risk from cyclone, but no wind risk. And some cyclones travel quite far inland and drop further rain. So the scheme will pick up that, and the yellow parts of the diagram are the flood components. The blue areas actually have no cyclone wind or cyclone flood risk in our modelling. We would still cover a claim if there was a loss in those areas, but we don't collect premium from those areas. And the black or very dark grey areas on the chart are where there's actually no addresses, there's no properties in those areas. Australia is a very large continent. So what we do is we are targeting the premium reductions, in particular to high risk areas along the coastline and major population centres such as Townsville, Cairns, Mackay, all the way around to Darwin and the Pilbara. Thanks, Alexander. So the legislation requires ARPC to set prices in a legislated framework. So we have an internal actuarial team led by Pulkit Jain, our head of actuarial. Our actuarial consultants are Finity, and all of the work is reviewed by the Australian Government Actuary, and then it has to meet these legislative requirements. And so we go through a very detailed process to determine the pricing. We have 6 catastrophe models. Just jump back a slide, thanks. Yep. We have 6 catastrophe models that we analyse the exposure to cyclone to built environment. We also received data from insurers on exposure, and we looked at historic cyclone events, and we put all of that together and analyse it. And broadly, in a straightforward way to describe this, the premiums are set to break even. We do not hold any statutory or regulatory capital because the legislation enables us to access the Commonwealth balance sheet if losses exceed our funds. We have an unlimited guarantee of support from the government. So if we can pay an unlimited amount of cyclone events and an unlimited size of cyclone events. But we model this to look at all possible scenarios, and broadly we price to about a 1 in 83 year event, and our pricing has no margins for uncertainty, no margins for profit, and breaking even over time. And so this gives us the ability to provide the lowest possible cost to insurers to then pass through to their customers. It's purposely designed to transfer margin from low risk areas. So people in, for example, Brisbane and Perth won't see any meaningful change in their premiums, but the margins that we would otherwise have saved for them is being transferred to medium and high risk areas. So it is done in a very careful way with external scrutiny and review. And we've actually published the actuarial reports so that they are on our website. The rate tables are on the website. The analysis that we do is on the website. And we'll go through a process each year where we do 2 things. One will be a financial outlook report that just talks about the financial sustainability of the scheme. And then after that, we'll be looking at an annual cycle around maintaining the premium rates. Our objective is to keep premium rates as stable as possible. And in fact, a measure of success for me would be to have as minimal change as possible. And as I said, we've got the government backing us. We don't need to make short-term corrections. I think what we'll do is over time make adjustments to the premium rates, but it is important that we do maintain them. But our objective is absolutely to stabilise premium rates and reduce them, and that's what the premiums do. Thank you. I noticed some questions coming through. We'll pick those up shortly. I'm just let me get through the next two slides, and then we'll sort of go to questions. Thank you. We've got savings. So we got quizzed a lot on savings. I should just say that ARPC doesn't actually have a role in the savings part, so apart from we have to set the price to be as low as possible. And we don't have any visibility of what insurers are pricing. So insurers don't share with us the premiums. They share with us their risk exposure, and we set them a price for the cyclone component, but it's actually up to the insurer to set the price. The government has allocated funding to the ARPC, the Australian Competition and Consumer Commission, and they have a 5-year program. They've got 25 people, and they're going to be producing reports each year that looks at how insurers have passed through savings. So they're playing a monitoring role in the premiums. But we're obviously very interested in the impact of our premiums, and we're doing our own actuarial analysis to make sure that it's delivering as we're looking for as well. So I think I've covered these points. We'll go to the next slide, thanks. The government gave insurers time and flexibility to join. So I know that there's been a lot of angst in the community around insurers joining the pool. But again, as I said, we're going to have every single large insurer on the pool for the next cyclone season. 95% of houses will be covered. I think that small business and strata will be happening over the next 12 months, and potentially you've got real opportunities here to be in the market now. And most insurers are passing through the savings. We're talking to insurers, and savings are sort of flowing through. Allianz and Reinsurance were our two first customers. So Allianz announced they were joining on the 1st of January, and Reinsurance joined at the same time. And pragmatically, we've seen increased market share, and pragmatically, we've heard from those customers that there have been savings to their consumers. I like to always say a sample of one, but Alexander and I met a member of the community in Townsville, and they told us they had a $6,000 premium saving on their home insurance. And so they're the sorts of things we're trying to achieve. I think that brings us to the last slide for us. So we've already said this. Large insurers will all be on by the 1st of November, actually, and we're ready to go for that. And the small insurers by 31st of December. There's about another maybe 20 organisations that will be joining over the next year. But for home insurance, they represent about 5% of the market, and that will also see a bigger uptake of small business and strata. Hope that gives you a sense of the overall structure of the pool. I have one last thing to say. There's been a lot of debate on 48 hours and a bit of misinformation in the media about this. We're actually covering a cyclone from the moment it gets announced as a cyclone. They normally happen way offshore. So cyclones form out in the ocean. That's how they start, above warm water. And so we're announcing these things when they're well off land. As they approach the land and cross the land, then damage occurs. We're covering the entire period of that cyclone. If the cyclone runs for 3 days, or if it runs for 3 weeks, we're covering the entire period of the cyclone for all the wind, all the flooding that occurs during that period, and all the storm surge that happens during that period. Now, after the cyclone is downgraded to a tropical low or a storm, but non-cyclonic, we stop cover 48 hours after the declaration. So we're actually giving an additional period of cover of 48 hours after the cyclone ceases. And that picks up any remaining flooding in the area of the cyclone. So that's how the scheme operates, and we are covering all claims costs from the ground up. So above the customer excess, we're paying the entirety of the claim. we're working with insurers to help them continue to deliver their claim service to the community, and we're fully reimbursing insurers for that work to make sure that consumers have no friction or impact behind the scenes around the Cyclone Pool. Thank you. I'm going to pause there. I think I'll pass back to Steve.
Thank you, Christopher. That was very useful information, particularly the 48 hours bit, because we've had tons of feedback on that. There were questions coming through on that very topic. For those putting questions in the chat, we'll endeavour to get to those, but as mentioned, we do have another slide deck from CHU, plus some questions to flow between CHU and the ARPC, and try to make it as strata specific as possible. But before that, I'll pass over to Kim to present a small slide deck from CHU's perspective.
Thanks, Steve. Thanks, Chris. There's some great questions coming through in the chat. I would actually really like to get to these before we finish off. Yeah, and definitely while we've still got you. Here we go. So I guess at the CHU end, this has been a massive piece of work, and it hasn't just been people in CHU. It's been big collaboration with the ARPC. There was work with Treasury initially, and also then with our insurer partner who is QBE. And QBE actually worked really hard to make Strata one of their first products that they have put in the pool. So I think actually CHU and our Strata products and Flex as well is actually about the second product that QBE has been able to make live. And so for us, that's renewals effective from the 29th of July. So I'll sort of expand on what that means. But so what we've kind of had to do is we've had to sort of rebuild the rating of our products from the ground up. So we had to sort of extract the Cyclone part of premium and then insert the new pricing. And it sounds really easy, but I know it was a lot of work, and there was a lot of 7-day weeks from people in this organisation to sort of get it going as quickly as we have. And a big part of what we're doing here is actually also in the reporting. So the ACCC, I think, is the overseer of the implementation of this pool for insurers. And so there's a lot of reporting that needs to be done so that whilst the ARPC doesn't have visibility on insurer pricing, the ACCC can have some visibility and some confidence that insurers are passing on the savings from the pool to customers. There is, and I'll sort of show why in a minute, there's extenuating reinsurance implications for the insurers as well, which they're working through. So if I talk about QBE, for example, so QBE's got a 1st of January reinsurance program. And so when we implement the pool for the second part of the year, they're going to have 2 programs running effectively. And then what they're going to spend the rest of the year doing between going live and their next reinsurance renewal, which is 1st of January again, is working out what's actually the pricing around these things that get left. So reinsurers and insurers still need to be covering that are outside the pool. So that might be things, for example, the ex-tropical cyclone that breaks land and does damage, the tropical low pressure system that we saw with Cyclone Yasi, where the tail went down and kind of did a lot more damage in Melbourne than it did in far north Queensland. And so there's a lot of things that are still needing to be priced for by the reinsurers, and it's working out what's actually the appropriate number there, and trying as best they can to make sure customers don't pay twice, or the insurers on the flip side have any gaps in what they bought cover for. So it's been quite complicated, but I think from my perspective, What we're seeing in the pricing that has come through for our customers is really, really, really pleasing. So our up north customers, we're seeing average premium changes of 37%. And then you've got your southeast Queensland, northern New South Wales, who are also seeing premium relief as well, which I think is a great outcome, because, you know, when this pool was announced only a couple of years ago, this is what everyone wanted. But it's great to see that it ends up where we were hoping. So I'll skip on to this slide. What I sort of want to talk about is how cyclones then affect premium. So this is an Australian average premium, right? So this isn't far north Queensland, and this isn't Adelaide. This is Australia altogether. And so what you see is your catastrophe events build up a lot of the premium side of pricing. And so you'll see there that cyclone isn't terribly different to earthquake on an Australia-wide basis. And then you've got your other nasty things, which we really don't like in strata, is hail. So hail's probably the largest event that can happen in strata, because we've got large roofs, expansive roofs, and they can also be quite high off the ground in built-up areas. And they never build roofs of strata title buildings to be retrofitted, let me tell you. So hail's kind of the big one for us, and then storm. So that's your just general windstorm, etc. And then in insurance generally, you'll find that bushfire is a big part of the pricing, but in strata it's really not a big part of the pricing, and the reason for that is that most strata is in quite urban areas, and so we're less affected by those big El Nino type events, and then La Nina's the one that kind of hits us, and that's where your cyclone, your hail, your windstorm kind of hit. So then if I go, I've got my slides out of order. So think about this little cyclone bit. It doesn't look very significant when you're looking at it here in the context of premium for a policy in Australia. But then if we do this, we're breaking it down to Cresta zones, right? So Australia's divided up into zones for insurance purposes. I don't even know what Cresta actually stands for. I bet Dr. Chris Wallace knows.
It's just a geographic area used by the reinsurance industry. It was invented by the reinsurance market, actually.
There you go. So what I'm looking at here is I'm looking at Australia by geographical location, and then what we're seeing is the price per peril for those locations. Now, the cyclone bar is a green bar. And so what you can see is when we're in Broome, Darwin, Cairns, Townsville, Mackay, those green bars are really big. And so what that means is there's a big part of the premium is associated with cyclone risk. And so that's why when we're looking at this pool, we can see such big reductions and potential reductions for clients in far north Queensland, because the bigger that green bar is, the bigger the impact the pool can have on the overall premium. And you'll also see, so there's no impact in Sydney, Melbourne, Adelaide whatsoever, but even Perth, Gold Coast, Brisbane, Sunny Coast have cyclone premium attaching to them. And so they'll all benefit in some way from the pool, which is, again, really pleasing. And so this is a bit clunky, and it's a bit ugly. So what I'm looking at here is, how does a policy build up from the ground, and then why is it that the pool can be cheaper? And it's probably very, very basic compared to what Chris or Alex might explain, but what I'm trying to do is sort of say, well, why is it, and how can the pool be cheaper than just what insurers are doing? So I guess the building blocks are your estimated cost of claims, and then we've shown here a cyclone section, the reinsurance cost of that, then your other reinsurance perils. Then you've got insurer expenses, insurer margin, commission, intermediary commission, and taxes. And so that's sort of what goes into your insurance dollar, if you like, with strata. And so then if we pull out just the cyclone part, you pull out the cyclone part, you pull out the reinsurance, and then there's an associated expense with all of that. So insurer expense, profit margin, commission, intermediary commission, and tax all goes on top of those costs. So then what we're doing with our implementation of the pool is we're actually ripping all that stuff out, and we're replacing it with the pool's pricing, which is different. And I don't know, Chris, if when we get into the Q&A, you want to talk about a bit more in detail about the events you price to, compared to those big long tail cats that we'll see the general insurance market try and price to for their prudential standards, but it's quite different. And so what we see is that the cyclone pool premium will be what it is, but there's also an associated reduction in not having the insurer expense, not having the reinsurer cost of capital. And the cost of capital, which is setting aside that money for the event of a loss. So money's actually sitting around here in Australia in liquid form to be able to pay for these claims. And so with the pool, because it's a government-backed guarantee, there doesn't need to be that capital just sitting around. And so we don't have that cost of capital. There's not that expense part there for the insurers as well. So it's just slightly different. But when we're talking big numbers, that can have a big impact. And then when it's proportional to clients based on where they are. And so going back to this, the bigger that green bar is, the bigger the impact. And so that's why, and what we're seeing so far for the renewals that we have issued, the Far North Queensland, Far Northern Australia premiums are looking really, really pleasing, to the point where I've had brokers say, is this a mistake? Which is it's kind of good. It's a good problem to have. I think there's probably been times where you get that, is this a mistake, but it's going in the other direction. So with that, I didn't want to say too much more in terms of slideshow stuff, but we've probably got some good questions in.
Some really excellent questions in the chat. Steve, do you want to sort of curate those and present them to us?
Well, I've done my best to answer as we go along. There's plenty to go through, so just trying to pick those in between. So Tyrone Shandyman has put to the ARPC, I'll read it verbatim. The Assistant Treasurer expressed last year that the savings would not be as was previously advised and needed for some policyholders. What do you think needs to happen to enhance rates to provide greater savings to policyholders? Everyone wanted it, but insurers. End quote.
Yeah, so thank you, Steve. Thank you, Tyrone. Good to see you on the call. We've spent a fair bit of time in the Senate explaining savings. As I said in my opening remarks, ARPC doesn't have a legislated role in what the premiums are to the end consumer. So insurers retain responsibility to pass the savings through, and it's being monitored by the ARPC. ARPC has a specific role in monitoring the savings. and they'll be publishing reports on it. But our obligation is to have the lowest possible price. And I think in my last discussion to the Senate, I don't have the numbers with me, but we're trying to emphasise actually what the average premiums were. And so the average premiums that we're charging, particularly in those very high risk pressure zones, is actually quite modest compared to what's been happening in the insurance market. And the reason for the differences, as Kimberly was saying, is that we don't have to hold capital, so we don't have to get a return on capital. In fact, I said to the Senate that our long-term objective is to have zero capital. So if our goal is to break even, that should actually mean, in 5 years, 10 years time, that we don't have any surplus. And so I sort of see the premium rates as having sort of two parts to it. One part is the premiums have to cover the annual average loss, and that's a modelled view of the world. And our view of modelling will be different to insurers' view of modelling. We're using 6 models. We can take risk in a different way to insurers, and so so the annual average loss is meant to cover what you expect on an average year. And I saw a point in the chat, and quite rightly, what you observe in cyclones is you'll have many years, maybe 5 years in a row, where there's very modest, if no cyclone losses, and then you'll have a couple of years where there's billions of dollars of cyclone losses. And what insurers do is that they go, well, that might happen next year, so we need to make sure the premium is going to cover a large part of that. We can take a longer term view on it, and if we have a large loss event like that, we will be able to absorb it and finance it over a longer time horizon than insurers can. The second part of the premiums, though, which I see will evolve over the next 5 years, will be as our assets grow and shrink. And so if we end up with a surplus of assets because there's a low cyclone period, we would hope to be able to share that back with consumers in some way to achieve our long-term objective of break even. So I think that the rates are set to be as low as possible. They've been externally reviewed by Australian Government Actuary. We've done everything we can to get them as low as we can. And what we need to do is run them for a couple of years and see how the impact is on prices and how it works. But we are doing what we can to the lowest possible price. That's our goal. Alexander?
If I may just have one thing. I mean, we do a number of these sorts of presentations, and it never hurts to strip the answer back that step further so that people understand the context about things, because quite often people don't know sometimes what we're talking about. When we talk about the cost of capital, it's the amount of money that APRA, the prudential regulator, requires general insurers to retain so that they write business. And the reason that happened, if you aren't aware of the context, is about 20 years ago, there was an insurer called HIH, and APRA's supervisory responsibility for insurers was found to be wanting in some areas. And ever since then, APRA's been particularly careful to make sure that that doesn't happen again, a not on my watch attitude. And so what the prudential regulator does, and the brokers may not be as familiar with this as people in-house, is they have supervisory teams that make sure that insurance companies are adequately capitalised to write the business. This is a very, very big part of the puzzle for the insurance companies. And as Kim was saying earlier, that amount of money that they have to retain in order to write business and be in the game is a big part of what sets the premium. So for APRA to have confidence to step back from retaining that, for insurance companies to retain that capital and to have it covered by a government guarantee is a big deal, not just for premiums, but for insurance companies, for the Commonwealth Government and for the prudential regulator to have confidence that this is going to work. And that's why we're confident that the ACCC's role in monitoring prices and making sure that that cost of capital that APRA usually has responsibility. There we go, the lights are going, hang on, where we go? There we are, back with you. That cost of capital that comes out of it is going to work the way that it's intended to, but there's a lot of back work that makes other players in this process comfortable in order to pass on the savings and not have the requirement for that same cost of capital, that same capital.
There's probably a bunch of people, Alex, on this call who don't know about HIH, either because they're too young or because they're not from insurance circles. But HIH was actually an insurance company that collapsed and couldn't pay claims to its customers. And so that's the role of APRA, isn't it? Just to make sure that every insurer that sells a policy in Australia has the money to pay all of its claims.
That's right. That regulator has muscle memory from the pain of that company's collapse. That's what drives APRA's supervisory role of the insurance industry. That's what drives their requirement that insurance companies retain large amounts of capital in order to write the business. What this pool does is relieve Kim's responsibility and those of her colleagues from retaining that big chunk of cash and the cost associated with retaining that cash in order to write the business and offer the policies that the brokers are putting out there before their clients. That's how this works.
Yeah, it's a really good, it's a good point.
Thank you for the input on that. We'll see if we can get some other questions covered. You answered two questions in one there, both of you actually, because one of our attendees raised a question of they hadn't had a cyclone for a period of 5 years in Mackay. So you addressed that, as well as I can see CHU's own resident actuary also responded to that in writing. So very good. There was another question about a client received a Brisbane renewal and the risk the premium went up close to 25%. I won't be unfair and throw that to the ARPC, but I might take that one on board. Hopefully the messaging you've got behind this is the ARPC has come in and achieved through via all the levers they've been able to pull to achieve cheaper premiums on the cyclone exposure part of a premium. Insurers still have to price all the other perils that are exposed to property, be that fire, earthquake, all those things you saw in Kim's graph. So the pool aims to reduce premiums by providing relief from a cyclone perspective. That doesn't mean insurers have all their other perils priced at the required rate. So being in a high risk area does not equal automatically a reduction. It means the relief for a cyclone exposure will be passed through on the premium, on the overall premium tendered. But there are perils we need to price continuously, and the media is, as I won't wax lyrical on inflationary pressures and cost of logistics and so on, the media has done a good enough job of that for us. There's other pressures facing pricing, whether it's insurance or otherwise. So hopefully that answers that question. The aim of the pool is to pass on savings achieved through the cyclone, but it doesn't automatically mean an overall reduction in premium. It just means that that portion of a premium would be reduced. So if you're in a high risk area and receive 25%, what that means is it probably would have been much more considerable had the cyclone pool not come in. Hopefully that answers that question.
I'll quickly add a comment on Brisbane, very quickly. Brisbane's really interesting because it doesn't have a very big cyclone premium. It's quite small, and it's a low risk area. But our plausible large loss is actually a Category 2 cyclone hitting Brisbane. And our in the sort of the worst case scenario, that would cost about $13 billion in losses, and we will be covering that. And so the scheme structured to support that.
I bet you hope you never have to ask Mr. Albanese for that money.
That's right.
Do you know what I always think? Since Cyclone Seroja happened in WA, that town of Kalbarri is very much on the same latitude line as Brisbane, and so it's perfectly plausible that you do have a Cat 2 or larger in Brisbane, isn't it? Like it's not out of the realms of possibility whatsoever.
It's in our actuarial report, and we use that word exactly, plausible. So
yeah. There's Steve. I hope you don't mind me getting into this, but I'm seeing some questions in the chat that when I very first met Dr. Chris was at a town hall, and you gave, I thought, a very good and succinct answer around the class of property and what's classified residential, what's classified commercial in the terms of the pool. And so you're probably seeing in the chat questions about holiday letting, hotels, things like that. Did you want to sort of expand upon what will be included in the pool in the context of strata and holiday letting and resort style living, which we see in North Queensland?
Yeah, I'll do my best here, and I'll apologise if I get this wrong. If I get it wrong, we'll send an addendum. It is technical, and Alexander will come in and add to it. That we've actually provided to insurers a briefing note on how this is covered. So we have reviewed it carefully. So if a building is a strata building, has a strata, and I know there's differences in the way Queensland does this to New South Wales. But effectively, if it's a body corporate and not a business, and it's insured as a body corporate, if there's a short-term rental or Airbnb or a letting situation in there, that's going to be covered by the pool as it's a residential building. If the building is owned by a business and is owned by a business and it offers commercial lettings, then that's going to be a business, and it's going to be hit with the $5 million sort of threshold. So, but our understanding is many residential strata will fall into the scheme with the lettings, with the holiday lettings. Alexander, you want to add to that or correct it?
No, that's pretty accurate to me, Chris. I think that the work that we've done will give the clarity to the insurers, and all of this sort of stuff that we're doing with the insurers is going to be continuously reviewed. So it won't stay set in stone indefinitely, and we've got a really good relationship with the insurers just to stay on top of how it works.
Thank you. There was another question. I can't actually find it now. There's so many questions coming through, but the gist of it was that properties in Broome and other areas are being built to cyclone standards, particularly Northern Territory, post-Cyclone Tracy and so on. But I think it might be worth, Dr. Chris, if you could possibly just talk to, for 30 seconds, a minute, how that's actually factored in different types of construction and other building factors into the pricing when it comes to assessing cyclone exposure.
You shouldn't, from your perspective, selling the product, you shouldn't see any impact at all. So we worked with the insurance industry to design the premiums to fit within the current envelope of information that's collected. So there's no extra questions needed. So there couldn't be any impact on the way that the product is sold. Behind the scenes, we're getting data feeds from insurers. So we receive quarterly in arrears. We don't get any personally identifiable information, but we receive information on the risk, and so we're using that to analyse. So, but largely the premium rates fundamentally are a rate on the sum insured, and so the sum insured is the primary driver, and then that is modified based on location, building height, other building attributes. This one's in the home area. I mean, I know strata is your focus here today, but in the home insurance area, there's a little bit more sort of rating factors in it around how roofs are tied down, whether the window openings, whether garage doors are shuttered. What we're hoping to do over the next 2 years is work with James Cook University to actually build some extra rating factors in for strata to help encourage risk mitigation further. But the current rate, the strata are sort of as are in the market, and then over the next 2 years, we're going to try to improve them further with research with James Cook University.
And I know we're running short of time, so we won't be able to get to everything, Kim. But I just thought, based on the introduction of a pool, did you have any comments? And this is without notice, in terms of the North Queensland Strata Title Inspection Scheme, which is current, but has a current end date of 30th of June. Is there any byplay? Is that linked to future mitigation and possibly how the pool is going to be structured?
So it's interesting. It's something we weren't aware of. We're not sort of directly involved in risk reduction directly. In fact, I'll just say that the legislation prohibits us from directly funding risk mitigation, which is sad, but we're not allowed to fund a levy, or we're not allowed to fund a building before the event to do things. But we can actually fund, and we do get involved in thought leadership. So we're looking at working, as I said, with James Cook University on building standards. So how can we help develop together building standards that will help drive risk reduction? And we've done that in the terrorism space. In the terrorism area, we published with Standards Australia a handbook for business on risk reduction for terrorism. And so we hope to do the same in the cyclone area. And the other thing that we can do is in the claim event, which is we have a lot of power during the claim event because we're actually set up to fund claims. What we want to do is work with insurers around to what extent can we help insurers build back better. So, you know, after the event, we should be able to help build resilience to communities as well. So we have a number of activities underway on risk reduction because we can do thought leadership, we can help with standards, we can help bring parties together, we can do research, and we hope to be able to work through the claims response to help build resilience as well. But we do have some limitations in we can't just go out and fund programs like the strata inspection scheme, which looks great, but it's not something that's in our remit.
And I think that's probably partly because we do have to remind some people sometimes, we are a reinsurer, right? So, you know, we provide insurance to insurers. Our business model is B to B to C. And obviously we are acutely aware of community interests and community concerns and the importance that what we are doing has for a wide range of communities across Northern Australia. But in the end, the other parties that we have the commercial relationship with are insurance companies such as CHU rather than the end consumer. So the legislation wants us to stay focused on what we are doing as a reinsurer. And as Chris says, the other part that we can do, which is the thought leadership piece, that's entirely different.
Okay.
Steve, I was just thinking that we should address a couple of CHU specific things. So the first one is I saw someone asked a question in the chat about, hold on a minute, don't all insurers have to participate? And so this is after we've sort of said, yes, all insurers do need to participate. They've got different dates. So with CHU policies, the date effective is from renewals from the 29th of June. Now that doesn't get 29th of July, sorry. That doesn't get all of our policies in by 31/12, which is our requirement. And so there will be a date and we will let people know when the rest of those policies transfer into the pool. But yeah, certainly by the end of this year, every one of our customers will be within the pool. The next thing I was thinking of that we should just probably explain, and I think Alex, you've just touched on this, but people probably don't appreciate the ARPC's role because they've only known them with regards to terrorism. There haven't really been any claims. So I think it's worth sort of stressing that when we do need to make claims against this pool, from the insurer, from the insured to the broker or the strata manager, the process for them actually doesn't change at all when they're making a claim. So they'll just do what they did every other day of the year, which is to lodge their claims with CHU. And then what happens in the background is where the money eventually comes from and is recovered from will be the ARPC. But you're not going to be sitting there processing claims and talking to customers on the phone, right?
No.
You can if you want to.
Reinsurance recovery. We'll be working with insurers on this.
If we have a $12 billion event in Brisbane, we might need you to do some phones.
Happy to listen in.
Good answer.
And then Steve, I'm just looking if there's anything else we really should get to.
Yeah, just because we're short of time, so it's hard to filter.
Yeah, I think we've still got like 600 people on, so I think we should probably carry on a bit longer if Alex and Chris have got a little bit more time.
Yep.
Did you have some questions that you wanted to ask me about CHU or Strata?
Well, we one of our objectives is to actually encourage competition, and so everyone talks about premium savings, but in the explanatory memorandum, when the bill was passed into legislation, the government at the time, and with support, bilateral support for the scheme, was also talking about creating competition and encouraging new entry. And so we're very interested in new areas being covered and new cover being made available. So we just really wanted to encourage that. So there's probably opportunities to cover new areas and new risks, because it's going to be a while before small and specialist insurers join the pool. How did you see that as an opportunity for all of your network and for CHU?
I think so. Traditionally, CHU's underwriting guidelines haven't allowed us to write Northern Australia. Probably 5 years ago, we had a change to guidelines that allowed us to write Darwin, because it's that sort of lower risk. But Far Northern WA and Far North Queensland, and so for us, that was anything north of Bundaberg, Hervey Bay, very, very difficult. And so we basically got one product that's available up north, and it's actually quite contentious. And so most of what we actually do right in Far Northern Australia is under that. Now, our underwriting guidelines to date actually haven't changed, so we're still relatively hamstrung in, even after we go to 29th of July and our policies start going in, we've actually still got issues with new business. And so what we're being told is we need to wait until this 1st of January reinsurance renewal to see how everything else falls out the sides, before we'll have a much broader opportunity to write new business. And so for CHU as an underwriting agency, we want to write business anywhere, right? Like we're not risk carriers, but we do need to work to the underwriting guidelines of our insurer. And I'm sort of, I guess where I'm at is I'm very grateful to QBE to allow us to do what we've been able to do from the 29th of July, but it's also, it's not lost on me that complexity of what's about to happen, of working out what's in the pool and then what's the risk that's left outside the pool, to make sure that there's adequate reinsurance coverage for the other windstorm events.
I hope that insurers will get a good understanding of that over the next 12 months. And in our modelling, bushfire and the remaining flood risk and earthquake risk are all very modest in those areas up in Far North Queensland. And so we're very hopeful that the policy objective will get into play, and we'll see insurers open up their underwriting guidelines. So
yeah, I hope to see that as well. I think they're all being quite conservative at the moment. People are very focused on their renewal portfolios, because that's the ticket to the game. But yeah, my view is that so in Strata, this is a property heavy portfolio. Most of the premium that comes in is associated with property risk. We hold, I think, $500 billion worth of aggregate just in this portfolio. And so insurers, I think they're right to be cautious, but once you take away those big risks out of Northern Australia, it's hard to see why they would be reticent to place the remaining capital in those regions. And so I think it does allow for competition, and it does allow for more entrants.
Thank you.
Do you have any other questions, ARPC, for CHU, which you thought were relevant?
I think ARPC wants to evolve the premium rates for Strata, and so we're very open to feedback over the next year to see how we can further improve them. And we do know that we need to develop some rating factors to encourage risk reduction. So very open to any comments and feedback on that as well. But thank you for the opportunity to present today. I know there's a lot of questions we didn't answer. I'm happy to attempt over the next week or two to come back with some short answers on some of those.
Yeah, we might be able to do a Q&A, like a schedule output of some of these questions, because I think there's some common themes in there, but there's also just some really good questions that I think there would be a lot of people would have interest in the responses. So we may be able to do like a joint response to some of those.
Appreciate having people of Alex and Dr. Chris's caliber taking the time out to educate and present to our customer base. I know how busy you both are, so it's really appreciated, and I'm sure our customer base appreciates it too. Also, thank you to Kim Johnson as always. So again, thanks for joining, and we'll be in touch with more information and get some answers out for those very good questions. Have a good rest of the day.
Thank you, everyone.